I'm Jessica Minton for IB Times TV, and I'm joined by Jonathan Corpina from Meridian, who's going to give us a preview of Friday's jobs report. Jonathan, it's good to see you again. Thank you for joining me.
Thanks for having me.
Sure. So February, we saw the unemployment rate tick down from 7.9 to 7.7%. What do you predict we'll see happen on Friday?
I think what we're going to see is going to be amplified by what we've seen already in the unemployment, in the jobs numbers and the reoccurring claims numbers that we've seen before. So I think our numbers are probably going to stay where they are at this point. I don't think anyone's expecting a big shift, because I think if you look back at last month, I don't think anybody was expecting that shift there, and we did in fact see it. What's been interesting is that over time, our economic data throughout the month and our initial claims and reoccurring claims, there's been a little bit of a disconnect there between the economic data that we've seen and how that correlates to the unemployment number. So what we have been seeing, and we're going to continue to see, is the economic data has been supporting this rally that we've seen in the market, and is showing some sort of stability in our economy. But it's not really fully translating to the unemployment number. I think people would like to see that move a lot more quicker and a lot more movement to it. So at this point right now, what happens is that we get the unemployment at the end of the month, and the effect of that is probably a little bit of a negative effect, because it's somewhat of a reality check that brings us back to where we are.
Now, on March 1st, we did see those spending cuts in effect from the sequestration. Is that enough time in the long term to see how it will affect consumer spending and employment?
I don't think that's enough time. I think we need at least another quarter for that to really see some long-term effects and to see the outcome of what has been proposed over the previous 4 months. And I think also the longer that goes, that's going to bump up with the QE3 quantitative easing, if we're going to have more of that, or if that's going to be pulled back. So we're going to have these two push and pulls back and forth about the effects of it and about the effects of QE on our markets. So that timing is going to be interesting there, but I think it is too early to tell the exact effect of what we've seen coming into our new year and how consumers are spending their money.
And finally, in the last 2 years, we kind of saw a bust in employment happen, but by mid-year, it began to cool as certain sectors began to falter. Do you predict that in 2013, from the data we have seen, it will be able to kind of sustain this growth that we have seen?
I don't think so. And if you look back just at the first quarter so far this year and take it back from unemployment, and we'll just look at the overall market, Dow is up 10%, S&P's up 10%. Can that sustain throughout the year? I don't think we're going to be able to sustain the numbers that we've seen across the board, whether it's return on the markets or whether it's the economic data that we've seen. I don't think we're going to be able to hold on to it. It's going to be more of managing expectations and looking at the overall market and our overall economy on a yearly basis, just not on a quarterly basis. So yes, we're happy with what we've seen so far in the first quarter. Would I have liked it to be a little bit of a slower pace over a longer period of time? Yes, but I am happy where we are now. But in fact, where are we going to be moving forward in Q2 and Q3? Are we going to still see this movement? I don't think it's going to be as fast. We might take a step back, eventually have 2 steps forward, which will be healthy for our markets.
Thank you so much for joining me.
Thank you. Always a pleasure.